18. Well, as promised, let's get chatting with Pramod Gubbi, co-founder of Marcellus Investment Managers, who joins us on the show. Hi, Pramod. Good to speak to you after a while. How are you all feeling about the markets? As of now, things are looking pretty okay. We have inflation that's cooled off, and people are quite excited about that, because it's only around, I think it's the lowest we've seen in the last 6 years or so. However, part of the street is a little bit concerned, because the nominal GDP will not even be 10%. And that's after many, many years. You put together 6.5% growth with 2% inflation or thereabouts. We're falling short out there. What's your take on the markets? Do you believe that in the near term there could be some kind of problems because urban demand is not picking up? Or do you believe the RBI is growth focused? Things are going to recover in the second half of the year. So this is the start of the next leg of the up move.
Yep. Thanks for having me here. Like we've been saying over the last few quarters, I think we're coming off a period of pretty strong growth, driven by government capex and the consumer spending post-COVID. At some stage, both of these drivers had to cool off. I think the government is clearly on the fiscal consolidation path, although the first 2 months of this fiscal public capex has been strong. But I think going by government tax collections, that has only so much upside and perhaps could even cool off going ahead. The consumer piece as well is cyclical. Part of it is cyclical. You had a revenge spending boom. At some stage that had to cool off. In fact, the revenge spending was accentuated by retail borrowing. Most banks were flush with funds. They supported personal loans, microfinance, which accentuated that boom. That had to cool off as well. We are in the middle of that cool down. But there's a small element of a structural issue around job creation and recovery in consumption, given automation and AI is pervading all aspects of life. And company after company we speak to are talking about being skeptical of hiring. That's a big structural issue to be concerned about. Hopefully, we'll figure out other avenues to create jobs. For example, manufacturing is picking up, but that remains a concern. That also means that this slowdown and drop in inflation is expected, right? The inflation has dropped because naturally demand situation is cooled off quite significantly. At the same time, companies or corporates' pricing power is also cooled off significantly. So it's the other side of the demand cool off, which is the lower inflation. That also means that the RBI has a little more leeway in terms of loosening monetary policy, either by pumping in more liquidity, which is done quite a bit already, or cutting rates perhaps in the August round as well. Now, these effects will not by itself translate to demand creation. Maybe at the margin, certain projects become more viable because the cost of funding comes down. Hopefully towards the second half, we can see that come through. But we'll also need some uncertainty driven by the whole trade and tariffs things to go away for corporates to feel comfortable and start spending, both export demand as well as domestic demand. That is anybody's guess as of now. So for now, I reckon the market situation will be driven by a fairly modest demand environment, with a lot of hope in terms of monetary policy triggering a recovery. That will also mean that earnings slowdown that we've been through over the last 4 quarters is likely to sustain at least for the next couple of quarters. Which in the midst of where market valuations are, I reckon investors should be prepared for muted returns going forward, unless and until we see either a sharp correction or a recovery in the demand situation.
So how would you play all this, Pramod? The stress in the job market, tech companies are already, sort of flashing warning signs, no wage hikes. Hiring has slowed down. They're only doing specialized hiring. What about tech if consumption is going to get hurt? Because there is that ripple effect, as you spoke about. So till we get, and RBI has also sort of front-loaded the rate cuts. How do you play this in terms of an investment theme now, this muted phase return?
Like I said, for investors, the best approach is through asset allocation. At the end of the day, you have real, tangible financial goals, and you get your asset allocation right in terms of equities, fixed income, gold, and real estate. And within that, you get your allocation to large caps and small caps, quality versus value, and be systematic about rebalancing about this. As far as we are concerned as asset allocators, as asset managers, we're at the end of the day trying to position ourselves to give our clients better returns than what the index would give, which is their opportunity cost, by buying into a low-cost index fund so that we justify our fees. From that perspective, we are less concerned about the absolute returns in the market, right? Given we've got, 24-25% returns from the market in the last 4-5 years, that's unlikely to repeat. In fact, the next 5-year returns will be significantly below average, the long-term average for the Nifty being 12%. I reckon if the market gives 10%, to beat the market, you need to be positioned to give 12-13% on a post-fee basis. There'll always be opportunities from that perspective. So if you're relatively positioned to do better than the market, but at the same time being realistic about absolute returns, I think there are still opportunities in the market. Private banks, for example, is an opportunity where we think that while growth may not be significant, we reckon on a 5-year basis, you might still get 15% earnings growth. But at least valuations are reasonable. I won't say compelling or attractive, but compared to several other pockets of the market, they are not giving you potential downside risk from a derating perspective. So pockets like that do exist if you do manage your expectations in terms of absolute returns.
Pramod, how are you all feeling about the pain space? That's been a big pain point. Pains has been a pain point. But some believe that deal that was long awaited, that's out of the way. It's not a new player that's taken that stake in AkzoNobel. And maybe, India is bound to recover in the second half of the year. All that, the better prices will play out, discounts could hopefully go away, and things will look up. Are you in that camp?
Absolutely. I think the pain in the pain space that you're alluding to happened together because of both reasons coming, which is the macro slowdown in demand. Overall paint demand hasn't been this weak ever in India's history. I'm talking about decorative paints. At the same time, you saw competitive intensity coming up with a large new player coming in. Hopefully, like you mentioned, with the rate cuts playing through, there is a pickup in housing, and therefore paint demand recovers, at least from a statistical base effect perspective at some stage through the next 12 to 18 months, demand should recover. And we've seen the capital cycle play out. From a competitive intensity perspective, we've seen an exit of an existing player. And that capacity is bought in by an existing player as well. So to that extent, we're seeing competitive intensity actually get more benign compared to what we've seen in the last 3 years. So both demand recovering and competitive intensity becoming more stable, I would reckon the next 3 years should look good for paint companies, both in terms of growth and margins.
Thank you, Pramod, for joining in and providing that insight. Time to get into a break. But before